Good evening, ladies and gentlemen. Myself, Daniel, representing PMS Bazaar. It's my pleasure welcoming you all for this special AIF knowledge series, Emkay Dhan ki Baat, a 360-degree look at AIF products in India, presented by Emkay Investment Manager and PMS Bazaar. Now we have the industry experts in the panel to discuss on the subject, and let me introduce them before we kickstart. Mr. Sandeep Parekh. Sandeep is the managing partner of Finsec Law Advisors. He worked as an executive director at the Securities and Exchange Board of India and has been the faculty at the Indian Institute of Management, Ahmedabad. He is the author of a well-received book called Fraud, Manipulation, and Insider Trading in the Indian Securities Market. He is an independent director on the board of HDFC Bank Limited. He was the chairman of SEBI's Proxy Advisory Working Group and is a member of SEBI's Mutual Fund Advisory Committee. Welcome you, Sandeep. Mr. Somnath Mukherjee. Somnath is a chief investment officer of ASK Wealth Advisors. Prior to this, he spent over 16 years in wealth management, investment advisory, and strategy, global market, derivative, and structured products with Standard Chartered Bank in India and Singapore. He is an MBA from IIM Calcutta and BBS from the University of Delhi. He also holds the CFA and FRM charters from the CFA Institute. A warm welcome to you, Somnath. Mr. Subramaniam Krishnan. Subramaniam is a partner in EY's private equity and financial services, tax and regulatory service practice. He has over 23 years of experience and actively engages with the government and regulatory authorities for tax and regulatory change initiatives for the Indian alternatives ecosystem on behalf of Industry Association. Subbu is an active member of the Alternative Investment Policy Advisory Committee constituted by the Securities and Exchange Board of India. A warm welcome to you, Subramaniam. Mr. Vikaas M. Sachdeva. Vikaas is the CEO of Emkay Investment Manager, an industry veteran with over 2 decades of experience. Prior to this, Vikaas was the CEO of Edelweiss Asset Management Limited and was the global CEO of Inam Asset Management Limited. His industry affiliations include a seat at the Mutual Fund Advisory Committee, a special committee of industry professionals selected by SEBI to advise them on governing the MF industry. And he was also on the board of AMFI, heading the ETF and indexing committee, which submitted the first white paper to SEBI. Then we have Mr. Sachin Shah. Sachin is a fund manager of Emkay Investment Manager, a seasoned fund manager with over 2 decades of experience in the Indian equity market. By virtue of his extensive research, Sachin realized early on the need for a framework in which companies needed to be filtered out very objectively, leading to the development of Equal Risk, an Emkay Investment Manager's proprietary module, which helps to evaluate and compare listed companies on various aspects of governance. Without any further delay, we'll hand over this insightful sessions to the moderators, Mr. Vikaas and Mr. Sachin. Over to you, Mr. Vikaas.
Thank you, Daniel. Thanks for this very nice introduction. But as is my wont, I would like to introduce the panelists the way I see them. I've worked with the panelists for quite a few years. I've known them for quite a few years. I've been following them for quite a few years. So it's just fair that I introduce them the way I would like to do it. But at the outset, I just want to also thank PMS Bazaar for hosting this particular discussion. I think when I was discussing with you guys, it just took you half a minute to agree to it. Yes, this is an opportunity. A lot of listeners and a lot of people would be interested in knowing about this. So thank you so much for this. So let me just start off by introducing the panelists. I'd like to start off by introducing Sandeep Parekh. Sandeep, I was just listening to your qualifications and I think I am overwhelmed once again. You are quite modest. I was just listening to it and I was wondering that if anybody has any questions even beyond AIFs, this is the time to go and actually ask it. In fact, somebody described you as somebody who knows everything about everything in law. And I think that's quite a compliment. While everyone knows that you're quite articulate in your views, I think your 36,000 followers on Twitter will actually vouch for the fact that you have a very sardonic and deadpan sense of humor as well. Thank you so much for gracing the show. Subramaniam Krishnan, or Subbu, I always call him Subbu. It's very difficult for me to actually pronounce the full name because I always call him Subbu. I've saved your name as Subbu in my phone also, so pardon me for that. Subbu, as is popularly known in the industry, is the guy you go to when you want an immediate answer and a clear response on anything to do with tax. I worked with him for years across various organizations, and I've always come back impressed whenever I've talked to him. In fact, to summarize a discussion with Subbu, He handles tax, but his responses are not taxing. Somnath Mukherjee's knowledge of things belies his years. I have known Somnath ever since his early Standard Chartered days. Even then, I remember the industry buzz was always that if you want to come onto the platform of the bank, he's one guy who will ask you all the tough, incisive, and relevant questions. Well, if you follow him on Twitter, you would realize that his swath of academia is not the only thing which he's blessed with. He's equally at ease with both political and military affairs as well. So thank you, gentlemen, for gracing the occasion. I must also tell the audience that it just took them 30 seconds to agree to come onto the show. I didn't even have to really sell the show to them that this is what you're going to do. Say, yeah, knowledge, no problem. Yeah, yes, done. So thank you so much. Getting back to Emkay Dhan ki baat, it was actually conceptualized to get a ringside view of the exciting new age investment platforms and opportunities that have come up in recent years. Today's topic is alternate investment funds, or AIFs as they're popularly known. While the attempt is to cover all categories of AIFs, I think the overwhelming number of queries that have come into us either through the PMS Bazaar platform or on the MK Investment Managers platform or on Twitter, they've been primarily for Cat 3 AIF. So we're just jumping it up the league table. We're going to start off with the Cat 3 discussion, followed by Cat 1 and Cat 2 overviews. On that note, Sachin, I would request you to take over and start with the first series of questions.
Sure. Thank you, Vikaas. Thank you so much. And thank you to all our guests for honoring us and being with us today. So, let's start with Somnath, because Somnath has been in the industry, particularly on the product side, for more than 2 decades now. Somnath, working with all the multinational banks and even, currently with your profile at ASK. So, category 3 AIF, I mean, there is quite a few products within the category 3 AIF itself. Would you like to suggest some of the investment strategies which make sense, and then we can probably take it up from there?
Well, the Cat 3 AIF structure is the most suited one for 2 types of strategies. One, of course, is long short, including strategies that involve derivatives and leverage exposures. Pretty much the only legal structural vehicle available in India to offer such strategies today. And the second is an alternative to PMS as customized and concentrated boutique listed equity strategies, something like what MK probably has as well in terms of an AIF. What I mean by an alternative to PMS is being a unitized vehicle, being a vehicle that has less documentation and less operational challenges compared to setting up a PMS account. AIF Cat 3 provides a neater and more user-friendly, in fact, today, increasingly a completely digital experience in investing in boutique, high net worth listed equity solutions as well.
Right. And since, it's like a fund, as you said, compared to the PMS, it's like more unit based. So it becomes operationally also that much more better and quicker and scalable and easier, I would like to say. Right. So, and, in terms of strategies also, like there are some bespoke strategies where they talk about increasing the alpha, lowering the beta. You think these things are possible in the AIF? That is what AIF is really offering?
Structurally, yes. It does afford a certain amount of flexibility in terms of management that allows both lowering of beta and potential generation of higher alpha. Part of the reason why mutual funds, for example, struggle to generate alpha today is one size. Second, the guardrails that have increasingly come in over the years, all for good reasons in terms of investor protection and so on and so forth, especially for lower ticket investors coming in at 500 or 1,000 rupees. They also mitigate or constrain the ability to generate an alpha. An AIF vehicle, on the other hand, sans those some of those guardrails, afford a lot more flexibility, whether in terms of style bias, whether in terms of ability to move between themes as they rotate in the market, are rather more conducive to the generation of that alpha. Similarly, the ability to use derivatives, the ability to take leverage while using derivatives, has a singularly interesting set of possibilities on reducing risks on portfolios. One of them, of course, being reduction of beta.
Right. And, what profile of investors will AI be most suitable for? I mean, category 3.
Yeah, sophisticated investors. Clearly, these will have to be investors who are comfortable with a slightly higher risk asset class, which is equities and then going on to long shorts. These will have to be investors who also can understand a little bit of the technicalities of investing, and investors who would be open to riding out the drawdowns as much as they would obviously want to or potentially get the benefit of the increased alpha on the way up. So in a nutshell, it has to be a sophisticated investor.
And probably that's the reason why they have minimum ticket size as rupees 1 crore.
As 1 crore, yeah.
Got it.
So I must say that while wealth is a very good and fairly straightforward proxy, and ticket size is a good imprimatur for that, it is not necessarily the only thing in terms of gauging the sophistication of an investor. But clearly, that's probably the single most useful variable to define a sophisticated investor today.
Sure. Vikaas, before I jump to Sandeep, would you like to?
Yeah. In fact, this was a very interesting point. You talked about sophisticated. In fact, one of the questions which the audience has asked, and I'm going to come to Sandeep later on in the conversation, as to the difference between a sophisticated investor and an accredited investor. This was something which was very interesting. But Somnath, specifically to you, I think the general perception is that AIFs take more risk. Okay. Is that right or wrong? B, does this amplify, if it is right, then does this amplify the inherent risk in mid and small cap strategies? And how do you hedge the risk?
No, so I think the reason why it is important for only sophisticated investors to come in is precisely because of the first point, an understanding of what it is. An AIF does not necessarily increase risk. It all depends on the underlying strategy that the AIF follows. There could be AIF strategies that take incrementally higher risk than, say, the equity markets, the Nifty as a benchmark. And there could be indeed other AIF strategies that take much lower risk. In fact, as an objective, they look to dampen the risk of a long-only naked exposure to equities. So it's very important for investors coming in to understand and know the differences and accordingly allocate capital, rather than allocate capital to Cat 3 AIF. Cat 3 AIF is a vehicle. It's not a product. It's not a strategy. It affords the possibility to the fund manager to take higher risk. It also gives the flexibility for him and the tools for the fund manager to lower risk. But it's important for both the investor as well as the fund manager to have that dialogue and engagement so that the investor is very clear on what is the strategy he is investing into. A typical long short strategy will end up reducing the overall risk on the compared to the equity market. On the other hand, a strategy that makes a significant style bias towards, say, mid-cap investing, or a significant style bias towards, say, a high churn, a high beta kind of strategy would be increasing the risk compared to investing in an index. So very important to have investors who understand the nuance and understand the difference and then allocate capital accordingly.
Interesting. In fact, as a corollary, the question which I wanted to ask you is, if there is a relatively new fund manager in the AIF space, what should the investor keep in mind before assessing? Obviously, the advice of the wealth manager has to be taken in, but I'm just saying that if he has to get this comfort about a relatively new player in the AIF space, what are the few things he has to keep in mind?
Several. One, what has he done in the past? What has been his track record of things he has done in his previous life? Second, how is the current strategy being offered by him? How analogous is it to what he has done in the past? So a long-only manager suddenly offering a long short. Then the question is, what is the incremental expertise or competence or team that has been built to provide the long short layer over a long-only position? and vice versa. Somebody who's been excellent and has a long track record in managing hedge fund style long shorts earlier, now offering a long only portfolio, then the question clearly is, what part of the previous experience was relevant to the strategy being offered today? Third, what is the skin in the game that the manager brings to the table? Higher the skin in the game, obviously SEBI has rules in terms of minimum sponsor commitments, but those can sometimes be relatively small, especially if the fund grows. But certainly over and above that, what level of skin in the game does the fund manager show in terms of sponsor commitment? That gives a certain amount of comfort to the investor that the manager is truly putting his money where his mouth is. Obviously, there are tons of other things that are more technical in nature, but certainly these 3 or 4 would be the first checkboxes to look out for.
Interesting. That's a good point. Sachin, over to you.
Sure. Sandeep. So now I'll go jump to Sandeep. Sandeep, again, in terms of regulations, so clearly one of the points which Somnath just mentioned, the skin in the game. I think that is where at least AIFs have, been ahead of the game, in the sense that mutual funds didn't have that. I mean, now we are talking about today. I think I read somewhere that there is a regulation which is coming up for mutual funds also for the skin in the game. But AIFs already have that part, and you also had the option of fund managers and the employees of the AMC investing. But there's one more regulation which came up in terms of the funds of, the AIFs can actually be a part of funds of funds. And of course, they can also do direct equity. How does this exactly play out? Does this benefit overall? I mean, what is the perspective of the regulator for getting this kind of norms?
Sandeep, before you answer this question, can I just request you, if you think that by expanding the scope and including a couple of other examples from other investment avenues makes sense, please feel free to do it. I think you would be the best person to actually talk about that.
Sure. So thanks so much, Vikaas and Sachin, for having me here. I'll just give you, maybe before I answer your question, let me give you kind of a maybe 1.5-2 minute summary of AIFs in India, especially from the regulatory space. And it's been a very interesting journey, because till the regulations came around a decade back, we had a very hybrid sort of regulation. We had a venture capital regulation, and it was probably the only SEBI regulation which did not require mandatory registration. So you could be an unregistered venture capital, or you could register with SEBI. And, mainly, it was a branding exercise more than not even a tax issue. So from that, we've come a long way. I remember the initial years when the AIF regulations came in. Obviously, there were a lot of questions from SEBI, from professionals like us, and funds were tiny, and they barely made 20 crores. Now we have an industry which has already invested 2 lakh crores. So I think I won't say it's massive, but it's I think credible size. And we've again, there's been a whole journey of taxation. It was very painful till 2-3 years back when the budget announced, the relaxations and pass-through benefits for category 1 and 2. And I'm sure Subbu will speak more about it. But it created, which is still true for category 3. I mean, this is still not. It's based on opinions from lawyers and chartered accountants, which essentially means that if you directly invest in, let's say, Infosys shares, till 2 years back, you actually paid 0% long-term capital gains, right? Now, of course, you have capital gains. But till 2-3 years back, the difference was 0% versus marginal rate, which is 42%. So why would anybody? So which is the reason why category 3 really never picked up in the initial 5-6 years. So I think it's large enough for it to be of nuisance value that the tax guy comes after all cat 3, it's going to be a kind of complete pandemonium. So I don't think that will happen. And but again, as I said, we're still going with opinions. It's not part of the law. Both pass through. And again, as I said, Subbu is the better person to address this. With respect to, I think the question is, I think, has a very simple answer, which is, and the answer is diversification. I think AIFs are allowed to invest in other AIFs. Again, there's a relatively recent development. They were, in fact, if you look at old circulars, they actually specifically prohibit AIFs from investing in other AIFs. But now they do allow them, and I think the simple answer is diversification. And it's again, you can find examples of that in mutual funds, right? Mutual funds have fund of funds, and the idea is to have number one, diversification. Number two, I think it allows experts to handle their aspects. If there's a real estate AIF, they're probably better placed to handle that part of the investment. So you'd rather kind of rely on those investment managers to do their job, and you kind of do your job in whichever area you best at, and then you kind of pick up from their fund with respect to the real estate piece. So I think it makes sense in terms of specialization and diversification.
Got it. And the other good thing about the AIF in terms of the regulations is also the flexibility that it gives in terms of the collection of the funds. Like you can have a tenure where you can say that you could have an X commitment, but you just pay in terms of various milestones or installments kind of thing, where they say you pay 30% upfront, then you pay 25, 35 or 10, those kind of things, which is again very unique compared to a mutual fund or a PMS, right? So this regulations is something what is really unique to AI, right? What do you think about that?
Yeah, so I mean, so this is really coming from the fact that there's a minimum commitment which is required, which is 1 crore. Right. So I don't think SEBI wanted anybody to kind of say, okay, I'll pay you only 5,000 rupees now and pay the balance over a period. So of course there is a minimum upfront which is required, and subject to that, you're allowed to kind of put in more money, or put in 5% every month or whatever else milestone that is required. Mutual funds are kind of considered a very, so it's in a spectrum. Mutual funds are the most retail and the most over-regulated, and AIFs are kind of the most sophisticated people, and they are also kind of the least required. So I would, in fact, till 4 years back, I used to tell people that it's kind of almost completely law of contract. But I think now there are some regulations which have come in with respect to what you can do, what you can't do. But it was almost kind of everything was almost contained in the PPM or the marketing document which is there. So I think it's been a very interesting journey for AIFs.
Right, and like as we said that if you make a commitment, there's a minimum commitment of rupees 1 crore, but obviously you can pay in different installments subject to a minimum starting amount. But when there is a redemption, there is one big, very common question: can there be partial redemptions? Is that a possibility?
No, so partial redemption is usually not a possibility, and there have been some disputes also with when redemptions have if the fund has not been able to kind of liquidate its holdings after the tenure, and I'm presuming that's what you mean, that the fund has a tenure of 7 years, and what happens at the end of 7 years. You can get an extension, of course, 1 year extensions, etc. But there are cases in which they spill over beyond that because the real estate project is in difficulty. They're not able to pay back. So they're able to pay back 70%, and 30% is still stuck, stuff like that. So there is a concept of in-specie distribution as well, which means you kind of hand over the units of the underlying investments. But there's really kind of no specific provision for saying that, okay, we're not going to wind up the scheme now. So
Sandeep, actually, I was referring more to the category 3 partial redemptions. Like, for example, a tenure of a fund is 5 years. An investor started with, say, rupees 1 crore. Somewhere in the middle of the 3rd year, the value of the fund becomes, say, 1.3 crores. Okay. Can he do a redemption at the middle of the 3 years? So a part of it, he doesn't want to redeem the full. There's an exit window allowed by the fund. And but can he redeem, say, 20 lakhs, 50 lakhs, and he wants to continue with the balance amount? Is that possible?
So kind of you have open-ended and close-ended funds, right? So
right.
For a close-ended fund, the answer would be no, unless it's kind of stated in the document that at the end of 3 years you can redeem half your amount. With respect to open-ended scheme, it of course depends completely on the contract. So when can you redeem, when can you invest? Everything is kind of specified. So, but yeah, I mean, we've looked at this as a view, and if it's a close-ended fund, you can't really redeem before the time comes.
Right, but the regulation doesn't really halt you from doing partial redemptions. Like if it's 1 crore 30 lakhs, do you need to have a continuing amount of 1 crore, or like you
Yeah,
can
so
only do a
continuing
redemption?
amount of, yeah, so one continuing amount of 1 crore is one thing, and the second is that's the whole point of a close-ended fund, that you kind of hold on till the time the fund matures.
Got it.
But as I said, if the contract says that halfway down the line you can redeem half your money, then that should be okay.
Understood. Vikaas, over to you.
Yeah. So thank you so much. I think one of the things which you talked about over-regulated to being less than over-regulated in terms of mutual funds to AIFs. But in terms of AIF disclosure, do you think enough is being done to bring information and strategy about the strategy and returns to the level that investors can get in other investment products? I mean, as compared to a mutual fund, how would you rate disclosure in an AIF, or as compared to PMS, how do you rate disclosure to an AIF?
So let me state one thing which will make me unpopular with lawyers. Hopefully there aren't too many in the audience. But almost if you look at whether you look at SIDs of mutual funds, whether you look at prospectus for IPOs, whether you look at AIF, PPMs, they all are kind of marketing. They're kind of supposed to be marketing documents, which they are, of course, but they're also mainly legal documents, right? They're kind of defense documents. They're not there to disclose. They're not there to kind of illuminate. That's true of almost all the kind of disclosures that we've had. Having said that, I think the PPMs, at least most of the PPMs I've seen, are kind of reasonably sophisticated. They go into a lot of depth in terms of the market, the particular scheme, what is the offering details, etc. Is it kind of clear enough for most investors? It would be clear enough for more sophisticated investors, I would say. Not everybody who has a crore, really. But that's kind of the regulatory design, saying that there's a presumption that if you're rich, you're sophisticated. So that's kind of the basic thesis of AI, that if you're getting investments of a crore, your customers or your investors can take care of themselves, both from being legally advised, having the kind of sufficient financial knowledge to know where to invest, kind of have a sense of the risk involved, etc. So it's kind of, that's the basic regulatory premise of AIS, which is why I said it's kind of broadly it's the law of contract.
Again, I'm very tempted to ask you the difference between sophisticated and accredited investor right now, but I'm just going to hold myself back. I would rather get on to the point in terms of customer onboarding norms and regulatory requirements. Again, you mentioned something in terms of offer documents, but I think from an investor point of view, he delves more on the marketing document than the PPM. So to that extent, I think one can synthesize, one can crystallize, and one can give it to the investor. But when you're onboarding an investor, I think mutual funds have become far more simpler in terms of onboarding. But for an AIF product, it is still bulky and at times a little overwhelming for investors. You've been talking about a product for sophisticated investors. Do you think that there is a case for at least the customer onboarding to be simplified? And I'm asking you this to you deliberately because you're also on the advisory committee of SEBI. So maybe this is a message you might want to just give across.
And
this is in a lighter way. You may choose to ignore this.
And you taking away my livelihood as well, right? we thrive on complexity. Why would you want to make it simple?
Yeah.
No, but I think most of them are, I've seen plenty of marketing documents which are just 2-3 pages long. Of course, the PPM is shared, no doubt. But there's a lot of kind of marketing document which is simplified and shared with the investors. So I'm not sure it's kind of a big hurdle. And ultimately, if you kind of want to throw the law of contract, then you have to put all the minutiae, you need to put all the detail into your marketing document. So I don't think there's really a choice of reducing that 200-page PPM to a 5-pager. But as I said, people do have a short, a two-page newsletter kind of format marketing document as well. So I think it's pretty okay, except I think the problem, as I said, with all of these documents like a prospectus is kind of, they're full of jargon. They're kind of pretty complex, and unless you have Subbu and me sitting together, you can't kind of unravel them.
I think in defense of the documents available locally, I worked on some global PPMs, and I can tell you that they're a nightmare. I think the regulator has really cleaned it up for the local investors. The global documents are a nightmare. And I would love to be in your shoes when I'm advising global clients. Sachin, over to you.
Sure, sure. So I think I will now jump to Subbu. So Subbu, now, basically Somnath has already designed a good product for us. Sandeep has made sure that we are in the boundaries of the regulation. Markets have been more than kind, so my job has become easier. Profit बन गया है. So अभी खिचड़ी पक गई है और अभी हम लोग आपके पास आ रहे हैं. अभी कैसे बचाना है टैक्स को वो बताइए. So like Sandeep just mentioned, that was category 3 में तो challenges है, ये है, वो है. There are so many apprehensions about that. But I believe at least for the long only funds, there has been some circulars and there is a decent amount of clarity in terms of the taxation. If you could just share for everyone's benefit, once and for all, let's just get this thing out of our way.
Sure. Sure. Thanks, Sachin. Thanks everyone for having me here. I would say, Sandeep said it right. We unfortunately for category 3 funds, today category 3 funds represents almost 50,000 crores of commitments raised. I think it remains something which is quite unfortunate that we still do not have a formal tax code, which is available for every other investment vehicle that SEBI regulates, but we do not have one for category 3 funds for reasons best known, to the lawmakers. But having said that, I agree with you that there is a lot of apprehension or confusion that investors have when it comes to taxation of Cat 3 AIFs. I'll try to make it as simple as possible. And let's look at what practically is being done. There is a lot of technicality involved in it, but today 99% of category 3 AIFs are formed as trusts. So I'm restricting what I'm saying to trusts, and I know we may come to other forms a little later. But as far as trusts are concerned, if I am looking at a long only kind of fund, i.e. a fund that pretty much buys and holds equity shares, what today's AIFs do is they simply pay tax at capital gain tax rates at the highest surcharge potentially. When highest surcharge for equity shares in listed equity shares, as we know, is 15%. So that's really what, in a practical sense, a long only fund does as far as long-term capital gain is concerned. And this particular treatment, I think, is sort of supported by a very, very welcome clarification that the CBDT provided, about 4 years back, that as long as an investor in shares or listed securities consistently treats his investments as a capital asset and does not pick and choose the treatment, as it suits them, the characterization of such income as capital gains is not something that the taxman will come after you and challenge. So by and large, I would say for long only funds, to the extent you earn long-term gain, it's reasonably certain that your characterization as capital gain and paying, where you pay 10% plus 15% surcharge and 4% cess, should hold the fund in good stead and not create any extraordinary risk for either the fund or the investors. I think the question or the challenge, if only, is on the short-term gain component, where, and this is not unique to AIFs, to be very honest. Today, if you're a PMS investor, you're a direct investor in the market, you're a company that's investing, whatever you are, this is the issue of substance-oriented laws. We don't follow a rule-based system in India. We inherited law, frameworks of law that are more substance-oriented, and the whole characterization of whether short-term gain is trading profit or capital gain remains a controversy that has existed for all of the, whatever 100 years that income tax laws existed, perhaps in India. So I think that remains, I would say, debatable. Having said that, if you're a long-only fund where it's very clear that the intention of the fund manager at the point of time that he made the investment is to hold a security with a 12-month plus holding horizon, opportunistic sale before the 12-month period leading to short-term gain does not in itself mean that short-term gain will be taxed at, let's say, a maximum rate of 30% plus surcharge. By and large, most funds which have predominant long-term gain, but some short-term gain or loss as well, have been able to successfully contend that short-term gains will be taxed at 15%, which is the tax rate that applies to listed equity shares, and manage to successfully go through audits with that as well. And that would be, I would say, by and large, of course, dividend income is taxable at normal rates, so that's not an issue anyway. For a long only fund, I would say in a practical sense, this is really the sort of tax consequence one that one should budget. Of course, with, as Sandeep says, with all the ifs and buts that lawyers and tax professionals would throw into the documentation to safeguard the sponsors. But by and large, this is a treatment outcome that, most funds get, pretty successful at contesting.
Oh, that's very helpful, Subbu. I think that clears a lot of doubts, and we put a lot of ambiguity behind us. So basically, an extremely low portfolio churn, long only, typically maybe, large part of your investments are long-term capital. You've been holding them for more than 1 year. I think those funds are very clearly very safe in terms of the taxation side, is what I could gather. Will it be very similar, irrespective of the fund is open-ended or close-ended, from the investor's perspective?
Yes, I would say whatever I discussed, whatever I described, equally applies whether the fund is open-ended or closed-ended. Yes, in the context of open-ended, you would have, or you would see in your documentation, an additional point thrown, which is the whole risk of what they call MMR taxation. Because Indian trust law or Indian tax law for trusts have a provision that says that if you are, what is called an indeterminate trust, and we'll not go into the detail because people may get lost there. There is a provision in law that says maximum marginal rate may apply to all income of the trust. Technically, the view, and this is something which has gone through not in the context of AIF, but it's been debated in the judiciary otherwise in the context of a trust, that maximum marginal rate is meant to mean the maximum rate that applies to the type of income you earn. So even if you're an open-ended fund, which, like I said, in a long-only strategy is deriving capital gain from equity share sales, maximum marginal rate, even in an open-ended fund, is to mean the tax rate applicable to capital gain, but at the highest surcharge level. So you will not, depending on the total income, you may not be able to get the lower surcharge rates that apply based on total income. You may end up paying the full 15% surcharge, which applies to equity shares. But that's what it should mean in the worst case, technically speaking. And therefore, in that sense, whether you're open-ended or closed-ended, by and large, the outcomes from a tax perspective for a long-only strategy is not materially different.
So effectively, in the current tax rate structures for the long-term capital gains in the AIF category 3, it should be in the range of 11.5% to 12% maximum, is what we are saying, right?
That's right.
Got it. Okay, great. So this is I think puts a lot of doubts behind us. So this is very helpful. Should we now move to category 1?
Yeah, I think in the interest of time, and there are quite a few questions coming in.
Okay.
What I would request the panelists to do is, to just give an overview in terms of product regulation and tax on both Cat 1 and Cat 2 before we move on to the audience questions. Sachin, I think you should start off.
Okay. Somnath, so once again, coming back to you, the category 1 strategies are for what typically kind of products and suitable to which investors?
Yeah. Suitability is again clearly sophisticated investors, and obviously Vikaas mentioned difference between sophisticated and accredited. I think there are several versions of that, but whatever is commonly understood as sophisticated applies for Cat 1 and 2 as well. The structure itself has been set up regulatorily primarily to aid investments into early stage companies. Obviously, this is a segment or a nook of the market that has been buzzing now for the last couple of years. A lot of capital has come in, global, Indian, etc. And we've seen a significant amount of ramp up, both in terms of the check sizes for early stage capital, as well as in terms of the absolute amount of capital being deployed in this area, which is early stage angel investing, Series A, pre-Series A, call it what you will. So Cat 1 essentially is the right vehicle to be constructing such products for. So generally illiquid, longer term, very typically will not give any exit windows in the interim, and exits will only be in the form of exits in the investee companies as and when they happen.
Okay. And okay, Vikaas, over to you actually.
Yeah, I thought you would want to have more of a regulatory framework on Cat 1. Do you want to talk about that, or should we just go to Cat 2, Sachin?
No, so no, you carry on, Vikas. Yeah.
Okay. So let me just ask Sandeep here, in terms of regulation for Cat 1 AIFs, what does it entail in terms of sponsor commitment, reporting? And one interesting question which just came in was angel funds as a subcategory of venture capital fund under category 1 AIF are now eligible to invest in startups rather than VCUs. How does this broaden the investment horizon of angel funds? So if you could just highlight these two questions.
So let me be brief. I think the key difference is with respect to the skin in the game, which is much higher for category 3, which is 5% or 10 crores, whichever is lower. And for category 1 and 2, it's half that number really. So skin in the game is less for 1 and 2. The concept, the distinction between 1 and 2 originally was to kind of that category 1 was something which is socially beneficial, and therefore, if and when the government wants to give some benefits, they could give it to category 1 instead of to both 1 and 2. But for most purposes, as of today, 1 and 2 are quite similar. I don't think there's any kind of major subsidy being given to category 1 funds, etc. So in terms of disclosures, etc., there's not much of a distinction really between 1 and 2. The second kind of distinction between 3 versus 1 and 2 is 3 can be either open-ended or close-ended, whereas 1 and 2 are mandatorily they need to be close-ended. So I think those are kind of two key differences. Again, philosophically, just to put it very simply, category 1 is socially beneficial, category 2 is domestic private equity, and category 3 is kind of, crudely speaking, domestic hedge funds.
That's wonderful. I think you've just simplified the entire thing. I think that will be really well appreciated. Subbu, in terms of taxation for Cat 1 and Cat 2, if you could just very briefly throw some light.
Yeah, I think the way one should think about Cat 1 and 2 taxation quite simply is as against Cat 3, where the fund pays tax. In category 1 and 2, all of these are typically funds that are investing in, buy and hold equity shares or debt or convertible instruments. The tax framework is very clear and straightforward that the fund is essentially passed through, i.e. there's no tax paid at the fund level at all. All of the income that is earned at the fund level is treated as if the investor had made those underlying investments and earned those income or gains in their own hands. So the way the investor needs to think about it quite simply is, if I had made investments in all of those underlying portfolio companies as equity shares or debentures or whatever it is, whatever income is earned on those investments is what I am taxable on in the year in which the fund earns it. And of course, the fund does do a withholding tax for some or all of the tax that is payable, which you can get a credit for, but you essentially need to include it in your tax return, pay tax on it, net of whatever withholding is made by the fund. It's that straightforward, and there's barely any controversy or sort of doubts around the taxation framework for a category 1 and 2 AIF now.
That explains why most of the questions are coming in for category 3. Cat 1 and 2 seem to be fairly simple and straightforward.
Yeah.
So talking about questions, there were some questions which came in to us. In fact, right now, even as I see, there are some 14 questions which are lined up by the attendees. But I'll just take these 3 or 4 questions between me and Sachin. I'd like to just start off with Sandeep, and I've been really holding myself back to ask you this question. I really want to ask you this question. SEBI has approved framework for accredited investors, and what is the rationale behind this development? And what, according to you, and I know that you are the best place to answer this, is the difference between, the mindset difference between a sophisticated investor and accredited investor?
Okay, so first, let me kind of give you a context of AIFs are actually not supposed to be sold to sophisticated investors. There's no such requirement. There's no such requirement of even suitability. You can actually sell an AIF to a below poverty line person, theoretically speaking, right? There's as opposed to, a distributor, for instance, has very specific suitability. Even if a distributor is selling a mutual fund of 500 rupees, he has to go through extensive suitability to check, what is the income, what is the risk appetite, this, that. And it comes back to the first point which I made, which is SEBI has presumed that anybody who has 1 crore to invest is automatically A, rich, and B, therefore very sophisticated. there is no other requirement really. There's no obligation on the fund manager to ensure that the person has kind of financial literacy or is kind of super rich or sophisticated or any of the above. So long as 1 crore is coming from the person, it's everything is kind of everything else is not relevant. Now that changes with the accreditation process, which is kind of supposed to be for more kind of actually richer people and therefore even more sophisticated, presumed to be even more sophisticated. Again, there's no kind of financial literacy and stuff like that which is attached. It's just kind of basically net worth and income. Typically, 1 to 2 crores of income and 5 crores of net worth is what would get you through as an individual, as an accredited investor. And again, you need to accredit every year with a kind of a subsidiary for stock exchange, which will give you the certificate. Once you have that, then essentially you can invest a lower amount than 1 crore. I mean, that's the kind of, to keep it very simply, that's kind of the benefit which has been provided, that if we find you sophisticated enough by showing your net worth, that we'll allow you to invest even less than 1 crore. So I mean, that's kind of in short, that's what it means.
Interesting. Somnath, considering that these regulations are now coming in for accreditation of investors, what kind of impact do you see these regulations having on the AIF industry?
We'll have to see how it works out. There are obviously 2 levels of accreditation they have rolled out. One is simple AI, the other is very high net worth AI. So there is a VNAI segment as well, where a certain amount of greater flexibility on managing portfolios for strategies where a single LP provides 70 crores of capital has been given. Some of it seems a little bit very specific rather than a structural generic. I don't see too many strategies. I don't know what type of strategies would require single LP contributions of a minimum of 70 crores. So I think it's still early days on this AI SI front in India. Something that has been around in several of the advanced countries, including Asia, in Asia for a very long time. And there things are a lot more well defined in terms of access to investment products, specific types of investment products, specific ticket sizes for accessing those investment products are very clearly defined on whether somebody is an SI or an AI certified investor or not. I think we are just taking the first steps of figuring out how to do the definition first and how to get the accreditation first. And what benefits will flow through either on AIF or PMS or indeed any other investment vehicle access is, to my understanding, is still a work in progress. It's too early to determine one way or the other. There are some obvious ones. One could invest lesser to get access to an AIF. One could get access to a strategy with just 2 stocks if one is a VNAI with minimum 70 crores. One could have a different sort of arrangement under PMS, but a lot of it is still work in progress. How the rubber hits the ground when actual practitioners take over and start implementing it is something that will define how this finally shapes up. But it's a good move. One of the things about India is our regulations are always fairly quick to go from zero to right at the apex of what is available globally. So I'm pretty sure this will happen for AIs as well.
Yeah. Subbu, one of the main things, the buzzword actually is the gift city. So can you share what are the advantages of setting up an AIF in gift city from a taxation perspective and overall also, if you would like to share?
Sure. So when one thinks of gift city, obviously India's gift city is supposed to be India's answer to an offshore center. Obviously it was a brainchild of our Prime Minister when he was in, the Gujarat Chief Minister. And the idea is that, every country, every big financial center in the world has an offshore center, and they offer a bunch of benefits to, for financial services to be located there. Now, specifically in the context of AIF, gift city offers substantial advantages to the fund manager. because, or for that matter, other businesses, but given we are talking about AIFs for the fund manager particularly, because they get a 10-year tax holiday for their profits from a tax perspective out of the first, out of 15 years after they set up. So that's a very substantial benefit for a fund manager locating in GIFT, undertaking fund management services for an AIF. On the investor side, GIFT is, and there have been significant liberalizations made or relaxations made to the tax law. If you are a fund manager who is, as an example, deploying a long short strategy, then there are meaningful exemptions. So essentially today, the GIFT tax framework for a category 3 AIF, which is very similar to the category 3 AIF in the mainland, if one could call it, essentially says that anything other than shares of an Indian company that a GIFT AIF invests in, the gains made on that are exempt. So today, it has put a GIFT fund on par with an FPI, which is set up in Singapore, Mauritius, or wherever else. So if I'm a foreign investor who has faith in a fund manager in India and has superior comfort with the strategy that an Indian fund manager provides, and if the fund manager is able to set up in GIFT, he's able to give a net of tax return which is comparable with what an FPI sitting in Singapore or Mauritius or US or wherever can provide to its investors. So in that sense, it provides a level playing platform to fund managers to be able to set up and get the advantages for benefits for themselves, but also equally be able to provide a comparable, if not better, net of tax return to the investors. But otherwise, if you look at purely from a long only strategy as an example, then there are no material advantages of being in GIFT for the investor itself, because on a long only strategy, equity shares get taxed in GIFT just the same way that it gets taxed in the mainland. So there are no particular advantages there. The advantages there would mainly be for the fund manager on his profits from fund management activity side. But yes, the former of what I said is obviously attracting a lot of interest amongst fund managers to set up in GIFT. And the hope is that, in 12 months from now, we should have few active funds set up in GIFT from an inbound investment into India perspective.
Yeah, so it actually basically also takes away the uncertainty or the ambiguity. Like every 2 years, 3 years, we hear there's some challenge with the Mauritius-India treaty. But if you're a fund set up in a GIFT city, I think that those challenges will no more be there for you, at least, right? For a fund which is part of the GIFT city.
Absolutely. As in one would hope so, but yes.
Okay. I like your disclaimer. Okay, great. Thank you. Vikaas, over to you.
Yeah, I think there are many questions I wanted to ask, but I think the audience questions are just pouring in. So already I have 19 questions, comments, insights, and I'm going to use my power of veto to skip through some of them, which I think have already been answered. Mahendra Kumar Gupta actually asked, which is more beneficial and tax efficient between PMS and AIF? Would you like to take that, Somnath? This is the tricky question.
No, a PMS for a range of strategies, PMS could potentially be, especially Cat 3. PMS can be a slightly more slightly better structure than AIF, as we discussed. Subbu mentioned that Cat 3 AIF, the tax structure is exactly the same, right? For whether the investor is an individual, a corporate, an LLP, a trust, or whatever else he is, the tax that he is bound to pay while investing in a Cat 3 AIF is exactly the same. For long shorts that treat most of these as income, the Cat 3 AIF will pay the highest marginal rate of tax. For capital gains, he'll pay the capital gains tax. So the long only strategies, he'll pay capital gains tax. Now, compared to that, a PMS has the flexibility at the end of the investor, depending on his tax status and tax file, to choose which bracket he falls under. So if there is an investor who falls in a lower tax bracket, maybe he is a corporate entity or whatever else, then even a long short strategy, which pays full business income tax, will end up with a lesser tax burden than if the same strategy was operated in a Cat 3 AIF. So ceteris paribus, I think PMS is still slightly better than Cat 3 AIF. Cat 2 AIF, the comparison is quite moot because PMSs have huge restrictions in terms of unlisted securities. So, yeah.
I think it's more towards Cat 3 only. But I'd just like to mention something here. When I was having this discussion with an ultra high net worth individual and we started getting to tax, he just dismissed me. He says, see, tax backs hum log sambhal lenge. You don't worry about that. You tell me how much return I'm going to make.
That is a certain traditional way of thinking, but by and large, that's changing, and Subbu might
I just threw it in the ring just to make things interesting. In fact, the way I look at PMS and AIF, just for Mr. Mahendra Kumar's understanding, is to put it very simplistically, and I have the benefit of working in the mutual fund industry for quite some time. The way I look at it is PMS is like an open-end mutual fund in a lot of ways in terms of customer appetite, customer risk appetite, for a sophisticated customer risk appetite. And AIF is more like a closed-end fund. And the benefit of a closed-end fund actually you see it visible in a time of a crisis. Last year, around this time, a lot of people withdrew money from open-end vehicles, probably at the trough of the market. In a closed-end fund, and I can tell you this from a live example because we are managing a closed-end fund, people who could not withdraw have actually reaped the benefits of being in a closed-end fund. So I think it's not just a tax efficiency which one needs to look at. I think both vehicles have their own advantages and tax is just one part of it. Mahendraji, I'm going to just skip the next question because it's more to do with corporate governance. Mr. Jyotina, thank you for your patience. Again, Mahendraji is asking, is AIF another name of hedge fund in India as normally known globally? What is the difference between AIF or hedge fund? I think that we have covered a bit. So I'm just, unless any of you have a view, I'll just skip that question and go to the next one. Does anyone have a view in terms of AIF and hedge fund, or should I just move to the next question?
Okay. You can go.
So I'll move to the, sorry?
Yeah, please go.
Yeah. So I think somebody's been vocal about, Parekh has been very vocal about this wonderful session. And the question here, I think this is something for you, Sandeep. On recent SEBI regulations with regards to AIF, do you think benchmarking will help? Also considering benchmarking activities done on semi-annual basis, do you think 6-month-old performance might mislead the investors, distributors, advisors? I'm not quite sure what is being asked, but if you have an insight, would like to share that?
I think I'm not the best person to answer this. I think in terms of how benchmarking will really kind of impact either investors or the fund itself. So I don't really have a perspective on it.
So I can probably, unless any of you have a view, I can just answer this very quickly. I think the benchmarks, and I can tell you this for a Cat 3 long only fund, the benchmarks are pretty similar across the board, whether it's a mutual fund, whether it's a PMS, or whether it's a, an AIF. The benchmarks which are used, Cat 3 AIF, are usually the same. I think the problem is that, there is not enough information flow in the industry at an industry level. Not enough data is being collected and shared. I think PMS Bazaar has done quite its bit in terms of the PMS segment, and that has really helped people like us to compare one strategy with the other. But in terms of AIFs, I think there is still some amount of standardization which is required, which is where I think this question is coming in from. Vikrant asks, do long-short strategies short sell securities, or do they use only derivatives for shorts? In the developed markets, long-short hedge funds actually short sell. Is that not the case in India? If not, why? Any of the panelists can take this question.
No, so I don't think in India the long short strategies use short sell. In any case, it's not terribly efficient and not a liquid segment of the market in India, short selling. So bulk of the hedge fund style strategies in India use derivatives, either stock or index.
Mr. Minder is quite prolific in his questions. He's asking, what is the track history in absolute returns of 10 years of a Cat 3 fund in India after taking into account inflation, rupee devaluation, max marginal tax rate, and AIF manager charges? I don't think we have a 10-year track record in AIF right now, right? So, Minder, I think what you can use is as a proxy of the fund manager in a different vehicle. For example, Sachin has been managing some of our funds in the PMS segment for 10 years. And he runs a small cap strategy in PMS as well as in AIF. You could look at his, and I'm sure that if you reach out to any of your wealth advisors, they'll be able to give you a much better insight. I think Somnath, you touched upon that when you started off, when you were talking about evaluation of new fund managers. Nilesh asks, in MF industry, there is an increasing trend of passive funds. Does this mean that new age AIFs like True Beacon with performance linked to commission will gain prominence? Kindly put this in perspective. Somnath, would you like to take that because it's specifically talking about the product?
Yeah, so I think two different points here. One is about passives. Now, there's no reason for passives to be in AIF. AIF is a singularly, inefficient vehicle to have passives. The beauty of passives is easy access, extremely liquid, ideally listed, and available at very, very low ticket sizes, ideally digitally. So all of them militate quite violently against, or most of them rather, militate quite violently against the basic construct of an AIF for what it stands for. So I don't think passive strategies, and by passive I mean index investing, is quite the right strategy to be housed in an AIF. About fee structures being more skewed towards performance sharing as opposed to fixed, I think there is no single answer to that. Depends on the strategy, depends on the fund manager's own track record. Sometimes newer fund managers would like to keep their fixed fees quite low, close to zero, and simply charge more on the performance side because he wants to establish that that credibility and show increased skin in the game. Sometimes some of the strategies make sense from a higher variable, lower fixed kind of fees, and sometimes it's the other way around. There are always these break-even points, right? At some stage, your variable fees will end up being a lot more than your fixed fees at a certain hurdle rate of returns. So it's a good move, and it's something that is only possible in AIF and PMS as well. To be able to structure a fee solution that is a mix of variable and fixed, something not possible in mutual funds. But is that some sort of a nirvana or panacea? The answer is no. It's very contextual to the strategy and the manager itself.
Subbu, before we started off this discussion, you were talking about rapid fire questions. I wish you would have asked for India winning the test match, you would have got it because there are so many questions. I'm going to ask you to quickly answer all of them. These are going to be rapid fire questions coming to you. What is the taxation point in CAT 2 AIF for NRIs? Is TRC applicable?
Yes. If you want a treaty rate, yes.
Okay. What's the tax liability on debt portion on a long only CAT 3 fund that is held for more than 3 years?
If it's capital gain, it would be capital gain. As in 3 years I'm assuming the reference is to unlisted debt. So that would typically be 20% capital gains tax.
Okay. So SPS John, actually, I don't know whether it's a question or a comment. I'm just going to read it. So in both PMS and AIF, pay 15%, which is at the highest rate, and forget it. So I don't know whether you'd like to comment on that because I'm not sure whether it's a question or a comment.
In both PMS and AIF, you pay 15%.
I think he's referring to the short-term capital gains. I guess he's referring to the short-term capital gains. Yeah.
Will tax attract in case of transfer unit inheritance for CAT 3 long short strategy? For CAT 3 AIF long short strategy, will tax attract in case of transfer of units?
Yeah, it would be treated as transfer of property, which is taxable. Yes.
Okay. In category 2 funds, does the fund also pay TDS on each sell transaction, and also does the investor pay capital gain?
So in a CAT 3 fund per se, it operates on the philosophy that the fund pays tax on all its income. The investor, if he is not transferring units, he's just simply getting a distribution at redemption. Then there's no tax the investor pays. All tax is paid at the fund level.
Okay. There are a few more, but I'm just going to pause for a minute here. Sandeep, I think you may be wanting to answer this question. Your view on risk management with CAT 3 long short strategies seeing the market volatility. Would you like to take that? Or any of the panelists?
Yeah, so I mean, I'm not the best place to answer it. All I can say is, it's kind of these are kind of funny times. Though I mean, everything is kind of very well priced, including small cap stocks, alternates, etc. So it's I really don't have. I'm not a person who has a perspective on risk management, but I hope the AIFs, given the fact that unlike mutual funds, where you can see through very clearly what the strategy is, whether it's large cap, small cap, index, AIFs are kind of a lot less transparent in terms of where they invest, especially category 2. So I really hope that, they're not kind of throwing their money away on random investments, which are right now very current.
But having worked with a lot of people like you from the regulatory point of view, I can probably share here that in terms of a regulatory framework, I can talk only about Cat 3 because that is what I worked most upon. And I compare it to mutual funds. I think the levels of disclosure, the levels of the boundaries which have been set are quite exhaustive. So ergo, you need to have an extremely strong risk management. Otherwise, you're going to fall foul of one of the regulatory boundaries there. So I just like to assure everybody that just because the strategy is a little sophisticated does not mean that, or esoteric does not mean that it basically stretches the boundaries of law. In a sense, I think risk management for the AIF industry is one of the best, and I'll compare it to the mutual fund industry as well. So there are a lot more questions. I'm just going to finish with one last question here, which is an interesting one and it's open for all the panelists. Could you throw some light on debt AIF products, such as private credit-based structured finance funds? Some insight into that. If any of the panelists could just throw some light.
So maybe I'll take a crack at it. So interesting asset class, interesting area. I think the general and gradual withdrawal of traditional pools of credit in the country, first banks, then NBFC, because of different reasons, has meant that there is a dearth of capital to service the sort of sub AAA, sub AA category of debt capital that is required. And clearly investor money, investor funds, the likes of AIFs can provide, have become a fairly important source of such capital. This is especially true for a range of special situations, for a range of mezzanine instruments, even pre-distress kind of situations, because the traditional modes of financing through banks and NBFCs have substantially dried up for many of them. And some of them are not even regulatorily allowed. Banks, for example, cannot fund financing of promoter equity, just to give an example. So some of those opportunities are seriously good ones for, again, sophisticated investors to evaluate. The tax structure, unfortunately, on debt for domestic investors in India is horrible. It's one of those things that needed urgent attention many years back, but for whatever reason hasn't gotten that. But as long as the tax situation can be managed through entities or whatever else, it does represent a significant opportunity, because credit pricing in India is getting better and better with traditional modes of financing going away.
So let me just add to that in terms of debt AIFs. I think the fund itself is permitted to only invest in debt securities and not get into lending. It's not kind of an NBFC, so they can't really do direct lending, and it's actually specifically prohibited. So I just wanted to flag
that's
that.
interesting. That's interesting.
The only interesting strategy I would add to that, which we are seeing a fair bit of traction in India, which is very popular in the West, is venture debt, which is which is essentially backing venture capital backed companies, straddling two funding rounds, where you get not only a debt return but also an equity kicker if the company eventually does well through warrants and other mechanisms. So that's the other strategy, when fair number of GPs in India are focused on that strategy as well. So very popular in the West, something that's available to under the AIF platform as well now. There are quite a number of active funds that have been operational for the last few years in that space.
Yes, Sachin, you wanted to say something?
Yeah, I had one question. Maybe Sandeep or Somnath can probably try to help us with that. For category 3, when it comes to valuations, it's a very transparent, very ethical, very, very realistic way of valuing your assets, because a large part of your businesses or the portfolio companies are basically all listed companies. So you have a daily basis valuations. But when it comes to category 2, or even probably category 1, where a large part of your portfolio is into unlisted, and where you have this also sometimes real estate projects and those kind of things. What are the regulations about, in terms of how do they ensure that the valuation report, which is given to the investor at the end of every quarter or 6 months yearly, is a very realistic is a very realistic picture of his valuation? Does the regulation say anything on this, and how does it practically also actually play out?
So for category 2, really, I mean, it's kind of based on whatever metrics which are employed. Obviously, they are unlisted, so there is a fairly large range of what is possible, and many of them are kind of invested in kind of longer gestation businesses. So really, kind of the valuation is going to be accurate only closer towards the end of the maturity of the fund. So I mean, you can't even vaguely compare it to a Cat 3, which is investing in listed companies. And many, of course, right now it's the flavor of the season to invest in loss-making companies. Companies with which have market cap of 300 times the turnover of the company and stuff like that. But I'm not here to say that it's all kind of gas, but I am saying that it's not very easy to value many of these businesses which Cat 2 funds invest in. And again, this is not based on bad faith. It's just kind of tough to do.
Right. And Somnath, I'm sure you also have some of your investments in category 2. Practically, how do you answer this question to your investors? Because I'm sure they ask you, is this a real value?
So that's a fair point. And I think there are Cat 2, of course, there's different types of strategies. There's the unlisted side, and within unlisted, there's the early stage side, and then there's the late stage side, and then there is real estate. Each of them has its own set of challenges in terms of valuation dynamics. The easiest to do are the late stage ones, where there is a fairly well discovered pricing, at least estimate that one can make. And many of them have a reasonable amount of trades on the secondary side happening from time to time. But clearly, early stage is massively tough to value. Currently, what managers do is the best that they can, which is value it up at the level of the latest funding round. And then if something material happens, then you take a judgment call of how much you need to mark it down. Usually, good managers will not tend to mark it up without an actual transaction taking place, so which is good. The only thing that happens is a markdown sans a transaction. Second, it's on the real estate side that there has been several challenges especially over the last 6-7 years, because valuation reports and actual tradable value of those assets have differed. But it is making the best out of a fairly tough situation. So it is the best that you can do as a fund. From an investor's perspective, what we ask investors to do is basically look at real metrics, which is not valuation linked IRRs for Cat 1, Cat 2, but real metrics like DPIs, which is distribution per investment, or MOCs, or multiple on capital invested. So actual distributions and actual multiples generated are better metrics to look at than MTM valuation linked IRRs.
Okay, great. That's very helpful. Thank you so much.
So I think one of the questions, just to answer, one of the questions was on corporate governance. So I forget the gentleman who asked it. We have a whole section. You can go to our website, www.nkim.com, wherein if you see Sachin's model of the equal model, I've been told that it is one of the more nuanced models in terms of governance, that is G and ESG, that you will find in the industry. And I think that will answer a lot of your questions in terms of corporate governance and how we look at stocks there. So I think, Sachin, most of the questions which were asked at the end were the tough ones. I think the earlier ones were a little bit of a warm up, and I really enjoyed the last few questions which came from the audience and you. Thank you so much to the panelists for your time. And Daniel, over to you.
Thank you.
So thanks for all the panelists, and I take this opportunity to thank all the panelists, moderators, participants for joining us. Stay safe and a happy weekend. Once again, thank you all.